Welcome back to Boutiques on Wednesdays. I see that countdown clock got stuck in time somewhere, but oh God, thanks for fixing that. We are starting dead on time. Today we are going to look at an absolute gem of a fund in the multi-asset low equity category, the Fairtree BCI Select Cautious Fund, and how combining formidable equity and fixed income management teams can give your clients superior outcomes with lower volatility. Joining us this morning all the way from the UK is Bradley Anthony, Managing Director of Fairtree, to provide us with some insight on how they manage to consistently beat one, if not the top fund in this category. So Bradley, feel the pressure with that introduction. Good morning, how are you?
Morning, Eugene. I'm well, how are you?
Fantastic, thank you. A little bit earlier on your time, so thank you for making time for us this morning from London. I believe you are going to be in SA quite soon, and we might see you around in the streets. Looking forward to that. But for now, looking forward to your presentation on the cautious mandate and the cautious fund to see how you guys get it right to do so well.
Thanks, Eugene, and thanks for the opportunity to chat this morning. Thanks for everybody that's online as well. I still feel like I'm recovering a little bit from Sunday night, to be honest. I think in the last 5 minutes of the game, I was telling Eugene earlier that my heart rate hit 130 beats per minute just sitting on my couch watching the game. But what a fantastic game it was. So, yeah, good to be here and good to chat with all of you.
So with you being in the UK, I just want to know who you're going to shout for with England and SA. Right.
No.
No need to answer.
No. So morning everybody. I hope you can see my screen, Eugene. Everything looking
perfect.
Good? Fantastic.
Perfect.
So I'll just dive straight into it. I know we're short on time, so I'm going to give you a bit of an update on the BCI Select Cautious Fund. We're going to chat a little bit about the fund and then a little bit about almost our philosophy around the fund to help you understand why we do what we do within the fund. So let's dive straight into it. And then if we have a couple of minutes, I wouldn't mind giving you just 3 minutes of an update of the developments within the Fairtree group globally. So let's see how we go with time. So as I said, just a bit of an introduction. So let's dive straight into it. The Fairtree BCI Select Cautious Fund is a fund that we took over the portfolio management of in March 2017. It has a CPAP +3 benchmark. Pleased to say that over all measurement periods, since we took over the investment management and portfolio management responsibility for this fund, over all measurement periods, we've beaten that CPAP +3 benchmark. Our mindset around this, and we'll get into it a bit later, is that the objective here is to try to be as consistent in our ability to beat that benchmark over time. And what we believe is that if we do beat that benchmark over time, we will bubble to the surface in terms of the ranking relative to our peer group. So this is a 5-year annualized return ranking relative to the multi-asset low equity peer group. And the orange bar second from the left is the fund. And so you can see we rank fairly favorably relative to our peer group. And then if we look at the full period since we started managing the fund, we have to take the opportunity to throw the second slide in because it puts us at the furthest to the left. Our aim is not to be the top fund or the #1 fund in the category. Our aim is to try to consistently beat that CPAP +3 benchmark, and in doing so we believe that we will be in that sort of top quartile of funds in the category over time, and hopefully that continues. So just an overview of the fund to give you a sense of how it's managed. Within the group we think about 2 layers of portfolio management. The top layer is essentially an asset allocation and risk management layer, which is where I sit with the rest of my team. We're responsible for asset allocation and risk management primarily. One of the things that I want to stress, and you'll see this as we go through the rest of the presentation, is that our aim and objective as an asset allocation team is not to add alpha. Our aim and objective is primarily risk management. The alpha generation comes from the the underlying asset class portfolio management teams, which you all know. So within the group, we have a fairly well-known fixed income, equity, and property capability, global property capability, and we use those skills to build this portfolio and to generate alpha over time. So essentially, we think about the fund across three activities, and it's your typical kind of portfolio management type approach, where you have a strategic asset allocation framework, some tactical asset allocation, and security selection. As you can see in the title of the slide, the main focus of what we want to try to achieve is that highest probability of hitting the CPI +3 benchmark. And here's the key: it's with the smallest or the lowest variability in that outcome. And so the way in which we do that is we look at strategic asset allocation using primarily defensive assets, augmented with some growth assets. The defensive assets are essentially the income plus style assets that you all know, which Paul Crawford and Louis and Talman and his team actually manage on across a range of different portfolios within the group. The second element is your tactical asset allocation, and your third element is the security selection, where the alpha is generated. So let's delve into each very quickly. From a strategic asset allocation perspective, this is what the SAA looks like in the fund. Essentially, defensive cash plus assets make up 52% of the asset allocation. That's split between South Africa and global. That's then augmented with roughly 38% equity allocation, and that's South African equities. And then we have a small proportion of property as well. You'll see from the portfolio behavior that we have limited FX exposure. So even though we have global credit in the portfolio, we limit the FX exposure that gets introduced into the portfolio, because we view it as another factor risk which may result in greater variability of the outcome. That doesn't mean that we'll never have FX exposure. We're constantly kind of retesting our hypothesis on this, and we're constantly sort of checking our thesis as to whether that holds. We have been tested in the history of the fund. March 2020 was a very trying period, and having some FX exposure would have aided the portfolio and dampened the drawdown a little bit in the portfolio. But you also got to say, how often is a March 2020 event going to occur? And so we're constantly having to check whether that makes sense to have some hard currency exposure in the portfolio or not. But essentially, that's what the SAA looks like. From a security selection perspective, I'm going to show you a couple of charts now, which are essentially just efficient frontiers, to give you a sense of what we believe the drivers of alpha in the portfolio are, and why we believe that. So this is an efficient frontier, just blending the top 40 and the Albee. So if you think about the low equity multi-asset product, you have a limit on 40% equity exposure. So one of those dots there towards the left would probably represent a 40-60 type split. But essentially, those are incremental steps along the efficient frontier by blending those two indices together. The moment you introduce Fairtree capability and alpha producing capability, so if we replace Albee with Income Plus, you have an immediate increase in the overall return across the more conservative asset allocation blends. And then they all converge, obviously, back at the top 40 on the far right-hand side. So by introducing this alpha generating engine within the Fairtree group, you're already making a massive leap forward in terms of your alpha production, but also your risk reduction, essentially. As you can see, a lot of those more conservative blends to the left of the chart in the gray line exhibit lower volatility as well. And then if you introduce the Fairtree equity capability, which is essentially the fund that you all know, which is the Fairtree General Equity Fund, it immediately increases the alpha opportunity, or the alpha generation across the opportunity set. So in essence, what we're saying is that we have these proven alpha generating capabilities within the business, why go and try to replicate or reinvent the wheel? Let's use those alpha generating capabilities, but let's blend them in a way that meets the return objectives of this particular product. And then the final step, which is the one that I'm going to spend most of my time talking about, because I think it's the most topical conversation, is the tactical asset allocation. And we've said from day one that we're not going to be overly tactical. We believe that our goal is to try to protect the portfolio against large crashes, so large pullbacks in markets. And so this is a stylized depiction of how we see tactical asset allocation. There are going to be mini pullbacks that happen over time. And through those mini pullbacks, we're generally going to rebalance back to the strategic asset allocation. The benefit of doing that is that as one asset class pulls back and another asset class rallies, and you rebalance back to SAA, you're essentially introducing a discipline of buying into weakness and selling into strength. And so I think that is the discipline that persists in the portfolio for 80-90% of the time. There are going to be occasions where we find ourselves at the precipice of a potentially large pullback or potentially large turnover in the economic cycle. And when that happens, we're going to be a little bit more defensive. We're going to think a bit more carefully about the exposure that we have in the portfolio towards risk assets. And again, I put that little box there that says you are here with a question mark, because we don't know. We have a sense that we are in the later stages, and I'm sure you've heard many commentators say this. We are in the later stages of the expansion cycle, and that there are many risks on the horizon. And the fact that we've had central banks raise rates as aggressively as they have over the past sort of 12 to 18 months, at some point we are of the opinion that something will break. And if you think back to Feb or March 2022, I did a presentation on R-star at one of the BCI conferences where I kind of put forward the case that the real effective neutral Fed funds rate is probably a lot lower than it has been in the past, and an aggressive hiking will result in something breaking in the economy. And we're still of the opinion that that's the case. We're yet to see it happen, but yeah, let's be cautious about the way forward. And the reason why we're careful about the way forward is this notion of hitting the return target with the highest probability and the lowest variability. And so again, just did a stylized kind of interpretation of what we think could happen to various asset classes should there be a large pullback. And this is looking at a stress which persists for a 1 year period, and trying to almost say, what does it look like in a stressed environment and then a severely stressed environment? And this is looking back over many years, 25 years, to see how these different asset classes behave based on their starting point from the time of that stress event. And so, it's not unlikely to see a drawdown of 20% in equity markets. And so looking at the South African equity market, we currently have a dividend yield in the market of 4.5%. That's a forward dividend yield, whether you believe it or not. I'm not debating that that point, but the reality is that's where the forward dividend yield is at the moment. And so if we accept that, we'll have a total return out of the SA equity market of minus 15.5% should we experience a drawdown of 20%. So basically what we're saying is that there'll be a change in price. There'll be some carryover dividend yield, which will result in a total return. In global equity space, if we assume that you have ZAR exposure and that the ZAR sells off to a certain extent, which dampens the drawdown, you end up with a minus 13% total return from global equities. And you can see the rest of them listed there. The important thing to note is that, we've been talking about, or commentators have been talking about this massive opportunity in local currency emerging market bonds. In South Africa specifically, many commentators have been talking about this dripping roast opportunity in South African bonds. Unfortunately, we've seen over the last while that that dripping roast can become a dropping roast, in that, you know, the environment could actually result in higher bond yields, even though they were attractive to start with. So we saw South African bond yields sell off by, you know, somewhere between 75 and 100 basis points over the last while. These things can happen. So in a stress environment, we believe you can probably crystallize a 6.5% capital loss if bond yields sell off by 100 basis points. But you have this carry, this interest carry that comes into the portfolio as a result of the coupons that these bonds split off, and so you end up with a positive return out of bonds, which is probably why it still remains relatively attractive as an asset class. If you look at credit, though, which is you know, always one of the things that people try to avoid, is they try to pivot out of credit early in order to avoid the losses which happen as a result of credit spreads widening or defaults occurring. Now, in that line item there on the stress environment, we said, let's assume credit spreads widen by 200 basis points. In the income plus construct, if that happens, we crystallize a loss of 3%. The current running yield on the income plus product is around 11.5%, which means that you still have 8.5% return, which accumulates through the course of the year. So that looks attractive. We haven't factored in defaults. There can be a default experience, but you'll see that the spread or the difference between credit and bonds is still at 2.5% outperformance over a 1-year period. So you need to have 2.5% of losses come through in the form of defaults, which is not something that we've experienced on a regular basis within Income Plus. If we then just look at a second scenario and we say, look at the severe stress environments, you know, you really want to be in cash. You don't want to be anywhere else, because cash is going to be the most defensive. But that's a difficult call to make. To shift everything into cash is not an easy decision from an asset allocation perspective. So despite the drawdowns that you'll see in credit in a severe stress environment, you're still ending up with a positive return. And so for that reason, we think at the moment that credit is probably still a good place to be from an asset allocation perspective. So what I want to do now is I want to spend the next couple of minutes just talking a little bit about this philosophy of ours and testing this hypothesis around the way we manage the portfolio, because hopefully what I've illustrated in the first bit is that the bulk of the returns are going to come from alpha generation. We're going to be very disciplined in rebalancing back to our strategic asset allocation. And we're not going to be doing a lot around tactical asset allocation, except if we go into a severe stress environment. And so let's test whether this makes sense. So the first thing I want to do before we get there is I want to talk about a study by a bunch of social scientists, two guys called Dunning and Kruger. And I don't know if you've ever been exposed to some of this work or the outcomes of some of this work, but it's very interesting and fascinating. Go and Google it. The thing that kind of prompted them to do this study is quite an interesting and funny story about a bank robbery. But yeah, go and Google it and have a read. So what they did was they basically took a bunch of people and they set a couple of questions to them. And they said, what do you think your perceived performance would be for a particular task? And it was a range of different tasks. You know, it wasn't just one specific thing. There were hundreds of different tasks, from cooking a meal, baking a cake, etc. So let's say, for example, to Eugene, what do you think your ability would be to bake a cake? How well do you think you can make a chocolate cake if we gave you all the ingredients and the recipe? And Eugene would sit somewhere along that blue line, his perceived performance. What they then did was they gave Eugene the recipe and they gave him all of the ingredients and they said, go ahead and bake the cake. And the actual outcome was the red line. And so what that showed them, and the results showed to them, was that if you looked across the x-axis and you looked at quartiles of actual performance, so the bottom quartile, the bottom red dot, is basically that grouping of individuals who performed the worst at the task, and the top quartile is those that perform best. But those same individuals perceived performance before actually fulfilling the task is plotted on the blue dots. So essentially, the people in the bottom quartile thought that they had the ability to bake the cake quite successfully, but unfortunately, when they actually fulfill the task, they failed at it. And so they looked at all these activities over time and kind of identified this cognitive bias of an overestimation of competency when there's a lack of experience or skill or knowledge about the particular task. And so I suppose if you then extrapolate that into investment management, there are a number of us, me included, that would think that I have a perceived ability to do certain things. And the most obvious one is to pick the right asset class at the right time. And so in picking the right asset class at the right time, I think that I can outperform my peers, I can outperform the market. But 95% of us actually sit in the category of those who will underperform that actual task vis-a-vis overperforming. So again, let's just pause and say, well, what are the objectives? The objectives are hitting that return target with the highest probability and the smallest variability of outcome. So what we thought we'd do was we test the hypothesis in the context of this Dunning-Kruger effect, and say, let's look at a binary portfolio. You can either be in bonds, as measured by the Alby, or you can be in the Fairtree Income Plus Fund. Would it be better to have a buy and hold strategy or to try to market time? And what do you think the success rate would be over a period of 10 years of a good market timer? Now, there are quite a number of us on the call, so I can't go through each one of you and ask you for your answer. But I would say just park in the back of your head. If you said, individual X is an excellent market timer, they can time switching between asset classes successfully. What do you think the success rate of a very good market timer would be in percentage terms? So do they get it right 75% of the time? Do they get it right 80% of the time? Do they get it right 50% of the time? And just keep that in the back of your head. So with perfect foresight, can we actually predict what the asset class would be that would be the best performer? And the way in which we do that is we said in this exercise, let's look at monthly periods. You could look at quarterly, you could look at annual. It doesn't really make a difference because this is the conceptual discussion, right? So we said, look at monthly periods. If you had the ability at the end of every month to pick between the two asset classes, Income Plus and Alby, what is your ability to pick the best asset class for the following period, for the month to come? And so it ends with a couple of outcomes that look like this. So we looked at 122 months, because I think that's the history of the Fairtree Flexible Income Plus Fund. 122 months, if you had perfect foresight. So in other words, at the end of every month, you pick the best asset class for the following month, and you invested 100 Rand at the beginning of that 122 months, you'd end up with 588 Rand today. So a great outcome. If you just use the buy and hold strategy, so you just bought the Fairtree Flexible Income Plus Fund, you just hold that, you'd end up with 232 Rand. If you had imperfect foresight, which means that every month you picked the exactly wrong asset class, you'd actually have lost money. You end up with 88 Rand. So just looking at this, I mean, it makes perfect sense that perfect foresight is really the holy grail of investing. If any one of us can get this asset allocation call right, we'd add so much value to our client portfolios. So that is really what we're trying to pursue and what we're trying to achieve as investors, I suppose. But when you look at the range of different success rates, you end up with these outcomes, these traces of success, essentially, for different levels of success. So what I mean by that, the line at the bottom is essentially saying that's your imperfect foresight. You're losing capital, and the one right at the top is perfect foresight, and every line in between represents a 10% incremental improvement in your success rate. And what we did was we ran a whole bunch of simulations across the potential outcomes for every success rate for every month. And that essentially produces a distribution of outcomes. So what these lines represent are the mean of the distribution for every success rate over that 10-year period for every month. And each success rate then has a simulated mean return and a simulated volatility. So I don't know if you can see the table at the bottom right, but the Fairtree Income Plus Fund produces returns over that period, a mean annualized return of, let's say, 8.5% with standard deviation of, let's say, 2, while Perfect Foresight produces 19% return with standard deviation of 4.5. And everything in between will give you a different outcome, a different mean and a different standard deviation of that mean return. But just to stress again, that's a mean return of the simulations for that particular success rate. So let's say a 75% success rate. Around that mean would be a variability of outcomes as well. So this is what the variability of outcomes look like. So you can see that at a perfect foresight outcome, which is 100% success rate, you can have no variability around the outcome because you're going to be right every time. If you have perfect imperfect foresight, there's no variability around the end value either, because you're going to get the wrong asset class every single time. But anything in between, you're going to have a degree of variability, because if you have 50% success rate, your success rate is going to result in variability, because you could have chosen the other asset class in that particular month. So over those 122 months, you have this variability of outcome. So if you look at, for example, around that 80% success rate, the end value varies by about 40 Rand around the mean. So you have volatility of the mean, and then you have variability around the mean as well, which results in a less favorable outcome. So if you looked at what that success rate looks like in order to have a higher probability of beating a buy and hold strategy, I asked you the question earlier about what do you think the success rate of a good market timer would be? If somebody was able to pick the right asset class 53% of the time, they would end up with an end value similar or better to the Fairtree Income Plus Fund. So just 53% of the time, you need to pick the right asset class. It seems like a low percentage. There's a standard deviation around that mean end value, though. So that 232.93, which is the end value for 53% of the time you're getting the call right, has a standard deviation. And that's about 29 Rand around that mean. So you could end up with, what's that, roughly 203 Rand, or you could end up with, closer to 260 Rand. But essentially, there's volatility that gets introduced through this asset allocation call as well. And so the volatility of the mean return, which ends up in the end value of 232 Rand, that volatility is actually higher than the Income Plus Fund. So I've just been a bit facetious there, and I said that essentially is return-free risk, because you end up with the same end value, but higher volatility. And so really what you want to do is you want to have a better success rate than 53%. And it's very small at the bottom there, excuse the size of the font, but once you get to 60% success rate, then the lower bound of the standard deviation of the end value exceeds that of the Fairtree Income Plus Fund. So you really need a 60% success rate in order to consistently beat the Income Plus Fund. Let's have a look at how that peer group has performed over time. So this is the multi-asset income peer group. And so if you only need a 60% success rate, or in fact, you need a 53% success rate to get close to Income Plus, you need a 60% success rate to be guaranteed of beating the Income Plus Fund. How many funds in the peer group have actually done that? And the answer is absolutely zero. None of them have been able to do it. So we have a peer group of highly skilled, highly competent fixed income managers who all they have to do is try to get the asset allocation call right 53% of the time, and none of them are able to do it, despite despite the opportunities which they talk about. The fact that sometimes bonds offer better value than credit, and they switch between bonds and credit and switch into property, etc. Despite all of this activity, What is the actual outcome? So there's a very compelling argument to pursue the holy grail of investing, an extremely compelling argument. But the reality is that none of us get anywhere close to it. And if you then introduce equities into the story, you can see perfect foresight in asset allocating between income plus and equities results in a massive outcome, 1,866 Rand in an end value after 122 months. It's obviously something we should be pursuing. And you only need a 49% success rate to end up with a mean end value similar to Fairtree Flexible Income Plus. You need a 55% success rate for the lower bound of that standard deviation to exceed Fairtree Flexible Income Plus. But you're doing that at volatility of closer to 8% versus the income plus volatility of closer to 2%. So for a high equity multi-asset product, to my mind, it makes sense to kind of give it a go, for lack of a better expression, to swing the bat and to use all your skill and insight and experience to try to asset allocate in order to improve the nominal returns of the portfolio, where volatility and kind of variability around the final outcome is not as massive an issue as it is in lower volatility products such as this fund. So our kind of final conclusion, I suppose, having done this exercise, is that for a conservative fund of this nature, something sitting in this low equity conservative, you see it in the name, the fund's called the cautious fund. It's meant to be cautious in its approach. It's meant to try to reduce the variability of that outcome. We can't allow our cognitive biases to entice us into trying to be too tactical, because over the years I've been involved in asset allocation teams, and whenever we ended up going back and measuring our value add over time, it's negligible, if positive at all. And so introducing that greater variability and greater volatility into the outcome for a low equity product, conservative product of this nature, we think it's imprudent to introduce that kind of factor risk. And so that's why, as a team, we rely on our security selection teams to generate alpha. We rely on our strategic asset allocation to guide the portfolio over time. And let me stress again, we're constantly questioning ourselves about that strategic asset allocation. We're actually going through a review process now in the fourth quarter of this year to again retest that hypothesis of how much we're allocating to each of the asset classes. But that middle bucket of activity, that tactical asset allocation, which is the one which we all love to talk about, because that's the holy grail. That's the one that gets you the 1,888 Rand end value if you're picking between equity and income plus. That's the one that we do the least in, because we are cognizant of the additional variability and volatility that it adds to the portfolio. So hopefully that gives you a sense of what we do within the cautious fund and what we'll continue to do. We hope that as we continue to do it, we do rise to the surface of portfolios and in the peer group. If you'll indulge me, Eugene, may I just give a bit of an update on Fairtree Global? Is that okay?
Yes, good.
While I have you for another 3 minutes, I thought, let me give you a bit of an update on where we are as a business. A couple of years ago, we decided that we wanted to internationalize the business and try to get some experience into global operations. And so today, where we stand today, in addition to our South African presence, we have offices in Guernsey, in the UK, and in the Netherlands. We have about 21 people across all of those offices, excluding Providence Hotels. I'll touch on that in a second. But yeah, Guernsey is a channel island next to Jersey between England and France, if you don't know. Bath is in the southwest of England. We have a hotel investment team sitting there, private markets team sitting there. We have an office in London, which is where Paul and some of his analysts sit. And then we have an office in Leiden, which is a town about 20 minutes by train from Schiphol in Amsterdam, where some of our private markets teams sit. And then in 2024, we actually we've just secured some office space in Guildford, which is essentially an hour out of London down south, so kind of due southwest out of London. And we'll create another hub there. It's just a great working environment with good transport links into London. From a markets perspective, we operate across private markets and public markets, as you know. That's the distinction we make in our minds. Public markets are essentially the things we were talking about now. All our unit trust funds, all our hedge funds. And then we also have a range of UCITS funds, which sit domiciled in Ireland on a platform, a UCITS platform in Ireland. And those are all accessible to offshore investors or investors who have offshore capital. We also have the feeder fund for Global Income Plus, which sits on the BCI platform for those investors who want to access these offshore UCITS but don't have capital offshore. And then from a private markets perspective, we have two kind of core areas within private markets. We have an operational real estate business. Essentially, what that is we go out and buy real estate assets, hotels, purpose-built student accommodation, and residential micro-living units. And we operate those as well. So what do we mean by operate? At the top there, when I was talking about the number of people in our global team, I said it excludes Providence Hotels. Providence Hotels is essentially an operational business that runs and operates these hotels, and we employ everybody from the general managers to the chefs, etc., which is very interesting for an investment management business to do. But it sits actually within the group alongside the asset management business. And the reason why we do that is because we think that for us to extract the most value for our investors out of the hotel investments, we need to be able to operate those hotels and drive value at the operational level. We do that in purpose-built student accommodation as well as in residential. And then so that's essentially what we do across the group. We continue to press into these markets, continue to look for opportunities. The reason for us doing this is that we want to try to find opportunities for South African investors who want to take cash offshore or want to access private markets and are looking for interesting ways to do that. We're about to start raising capital for our third hotel fund. We have two hotel funds which are both closed. We've done probably transactions to the value of close to £550 million across a range of our hotels over the past couple of years. Our growth equity, private equity business is based in the Netherlands, but we also have done some deals in South Africa as well, where we're looking to help businesses scale up. So these are really businesses that have a good foundation, looking to scale up, either to expand geographically or to expand operations, and we provide the capex to enable that. So a relatively new area of our business, but also growing quite nicely. Last comment that I want to make. Unfortunately, the Netherlands beat South Africa in the Cricket World Cup yesterday. But one of the more interesting developments is, at Fairtree, we constantly talk about what our purpose is, and our purpose is to enable all stakeholders to achieve or get closer to their kind of lifelong ambitions and dreams by interacting with the Fairtree Group. And that could be investors, it could be partners, it could be staff. And one of our staff members is a guy called Sybrand Engelbrecht, who joined us a couple of years ago after a very short but successful cricketing career. He played for South Africa in the Under-19 World Cup. He played for the Cobras. And then he joined us, moved to the Netherlands, was playing club cricket there for a number of years now, and was told a couple of months ago that he's eligible for selection for the Dutch team, for the Netherlands team, for the Cricket World Cup. He was selected, and he actually was in the starting 11 yesterday. He scored 19 runs, which wasn't bad. He came in at number 5. And he also took a really good catch towards the end of the game as well. So bittersweet for us at Fairtree. We were all rooting for South Africa, but at the same time, Sabrandt was representing the Netherlands, and so was very pleasing to see him live out his dream. That maybe he thought he hung up his boots, a couple of years ago, but the opportunity arose through relationships within the business, which resulted in him being able to move to the Netherlands, and yeah, this opportunity came about. So we're loving the journey. We're doing this with the mindset that we want to try to create opportunities for our investors, our partners, our staff. And so as we do this, we trust that we can continue to deliver on the promises we make to our investors, of delivering, decent returns for them, that meet their specific return objectives. So thank you for your time. Thanks for indulging me in this last couple of minutes, talking about the business, and yeah, happy to take questions.
Your business like that. Every time I listen to you, Bradley, I fall a little bit more in love with Fairtree. So good to see the developments on your side. Maybe just a couple of quick questions, but I might add that I can't bake a cake, so I would be one of those very low probabilities. Speaking of which, on that stress testing that you saw, something very interesting, not in the severe case, but in the normal stress test, and like I said, you almost reschooled my thinking around asset allocation, especially in a world where we all got the narrative very wrong over the past 18 months. So I understand now how it really works in your fund. But in that stress testing scenario, your SA equity drawdown was greater than your global equity drawdown. I would have thought it would be the other way around. If you look at global equity from a valuation point of view, very expensive, where SA is really well priced on a relative basis. But why would the drawdowns then in a stressed environment be higher than global equity?
So the only assumption which you've missed in that, which I maybe didn't explain well enough, was that those returns were in ZAR. And so the assumption is that you have a ZAR sell-off, which then dampens the drawdown. So yes, I agree with everything you've just said, except you're going to throw the rand in.
It's down global equity quickly. I know you guys are busy with your roadshows at the moment. You had the Pretoria last week, if I remember right. I saw a couple of people on the call there as well. And I know Ryan and your team is in Durban at the moment. But just in terms of your equity carve-out, beginning of the year, you were very optimistic on China, and I believe PGMs as well. Mm-hmm. How did the positioning around that change as part of the cautious fund in that equity carve-out?
Yeah, good question. So we came into the year, obviously, a little bit more bullish on China. We thought China reopening with a bit of stimulus would result in increased economic activity in China, which would be supportive of some of our diversified miners as well as PGMs. Clearly, that didn't play out. That's a call we got wrong in our equity building block. The equity building block was tilted towards that view. And as we saw that not playing out, we became more defensive in our exposure. So we actually moved the portfolio more defensively, reduced the PGM exposure. But of late, we've actually slowly started to increase the diversified mining exposure. There's a little bit more PGM exposure, not a lot, a little bit more. We do carry quite a bit of gold exposure because we are cautious and we are concerned. And so we have some gold equity exposure and some pure commodity exposure as well in the portfolio to try to defend against a potential drawdown.
No, but I mean, despite that, if you look at the 1 year returns, 6 months returns, you're still top quartile. So it's the strategy is clearly working. Just quickly on the global credit side, you've explained very nicely how your team comes together, all in all, in building this fund. And like I said in the introduction as well, you also reiterated, formidable teams that's proven themselves for a very long time in the fixed income and the equity space. Your BCI Income Plus fund, you've got some global credit in the fund, but I also see that you've got explicit global credit, and that would be naked, where the FX is not hedged in the Fairtree Global Income Plus. Was that added recently that you up your exposure to global credit?
No, so we've had global credit in the portfolio for pretty much since the inception of the fund. We do hedge that within the cautious fund. So we hedge the currency exposure within cautious. So what we're trying to do is we're trying to capture that that broader opportunity set of global credit without capturing the rand factor risk. So we take the global credit exposure, and within cautious we hedge the rand. So currently, global credit spreads are trading at around 400 basis points. 450 basis points above Euribor. The other interesting thing to note is that we've gone through a period now where the base rate is increased over time. So if you look back 18 months ago, global credit spreads were trading at 250 basis points roughly above Euribor. Euribor was effectively zero. So your total return was 250 basis points in euros. Today, your total return in euros is running closer to 750 basis points. And then you put the currency hedge on top of that, and you're getting to 11.5%, 12% in rand terms, total return from global credit. So it's a very attractive asset class at the moment for us.
Working well indeed. Bradley, this has been extremely insightful in terms of how the fund works, how you put everything together, and all these magnificent components just coming together and working extremely well. And thank you for that update on your business. Like I said, I fall in love with Fairtree every time I speak to you. I'll speak to you again soon. I believe you're in SA in the next week or two. Maybe we'll get to see a little bit more of you. To our audience out there, thank you so much for joining us. It's been very insightful indeed. Just a quick reminder, next week, Wednesday, the 25th of October, we've got Anchor Capital, and we'll resume our discussions on some top funds and looking at the world. Randy, to you and your team, thank you so much for making the time and joining us. And I'll speak to you again in the very near future.
Thank you so much. Thanks for your time.